Here to share what we can expect from the market and the broader economy in 2024 is Olaolu Aganga, Mercer's U.S. Chief Investment Officer. Olaolu, great to have you back.
Thank you for having me.
So we're looking at this year, and you're allocating away from U.S. equities. You prefer emerging markets, Japan, and global REITs. Why?
Correct. Now, I mean, clearly, U.S. equities had an amazing 2023. It was up, call it, 26%. That was fantastic. I don't know if anyone started off 23 thinking that was going to be the case. I think we're all calling for some version of recession, frankly. But if you look at 2024, given where valuations now today, is it going to continue? I think we're frankly looking at some of the unloved areas. So REITs down 20% from the peak of 2021. We think that's overdone. So REITs as a sector, why is it sold off so much? Because there are fears of exposures to office and the office sector, and then where they're getting their financing from. But if you were to look at the composition of REITs, there actually isn't that much exposure to office. So single digits, maybe 8% if you go across a number of different indices. And where do they get the financing from? The bond markets. But so we think the sell-off is overdone. We've leaned into some of those unloved areas. Emerging markets happens to be one of them, ties into our outlook. So growth, for example, in the U.S. has done really well. Areas like China have struggled a bit. But if you were to take a step back now and see where the value is, China and a number of those emerging market areas are presenting deep value.
So this brings me back to something I was raising earlier, which is this area of known knowns. It seems more likely now that the Fed's not going to raise anytime soon, that we're not going to be back at, 5% on the 10-year yield. So does that factor into how you feel about REITs, and how should investors think about, if we can agree mostly on that's high likelihood, what they should find more attractive?
Absolutely. So this would be, the third, at the end of the year, third consecutive meeting that the Fed left rates untouched. Now, if you were to look at market pricing, maybe there was some aggressive pricing that we're starting to see rate cuts as early as March. Frankly, yes, we agree with rate cuts, but we think it's probably more, call it middle of the year, that you could see some of that. Now, with the rate cuts that we're expecting in the U.S., lower inflation, of course, we think that the equity markets could remain, for the most part, in line. There's a lot that's moved with regards to AI technology. We saw that continue to ramp up in 23. There could be some element of 24. So the beaten down value sectors, I know we just talked about REITs, but I'll just reiterate that as some of the areas. You have to go beneath the surface, frankly, to start looking at valuation there. REITs is one of them. And then within fixed income, we have high yields. So the global high yield area looks attractive. High yields at like 8% for the most part. But we think there's some, frankly, relative value plays that exist. As a long-term asset owners, we focus on asset allocation and allocating to funds, but we do migrate the portfolios tactically speaking.
Last time you were on with us, you talked about shifting some exposure from public equities to private markets. Is that a playbook that still works in 2024?
Yes, very much so. These are, as you mentioned, long-term plays. We are looking at forward calendars today. There are many, many funds that are coming to markets across. We talked about infrastructure, I believe, real estate, some of the value add plays. You're seeing distressed opportunities and valuations even in private markets. And with investors such as ourselves that have long-term holding periods, very, very much a focus. And private credit as well.
And we're having this conversation. It sounds like you're in the soft landing camp. Is that right to assume? And heaven forbid it's not a soft landing. Heaven forbid this is the year we get a recession. How does all of this investment thesis play out?
So that is not our base case with regards to having a recession. 23. That was the call, and we saw how the markets played out. There have been gradual rate hikes, and then obviously the last ending of the year, it was a series of pauses. But as we're looking at 24, as we look at risks, we have 60 countries that are having elections this year. So there's a lot of we're already in a heightened geopolitical environment, but there's a lot that's riding on 24 as a big year where policymakers need to be really careful.